most dangerous shifts in financial history never announce themselves with alarms, headlines, or panic. They unfold quietly, while the world is busy watching markets, elections, and distractions. And by the time people realize what changed the rules of money, no longer work the way they used to. This is FINSFAR, where we decode financial power, history, and the forces shaping the future before they become obvious. Currency wars never begin with collapsing charts or emergency speeches. They begin with silence, subtle decisions made behind closed doors that feel harmless at first, almost technical. But history shows these moments are where economic destinies quietly split. When governments adjust interest rates, expand balance sheets, manipulate trade flows, or redefine what stability means, they aren't just managing economies, they are positioning currencies for survival. Most people imagine currency wars as dramatic devaluations or sudden crises, but the truth is far more unsettling. The early phase looks calm, rational, even boring. In the 1930s, nations didn't declare currency conflict. They quietly abandoned gold standards one by one. In the 1970s, the dollar didn't collapse overnight. It slowly detached from gold while confidence masked the consequences. And today, we are once again living in that quiet phase, where policies are framed as temporary, necessary, or data-dependent. Yet the cumulative effect is permanent. Here's the uncomfortable part. When policy shifts become normalized, trust erodes invisibly. Investors adapt first, then institutions, and only much later does the public realize purchasing power has changed, savings behave differently, and economic rules feel unfamiliar. Currency wars aren't fought with weapons. They're fought with patience, timing, and narratives that convince people nothing is wrong until everything feels different. And the real danger isn't collapse, it's adjustment without awareness. If this silence is the opening move, who is positioning correctly right now, who is exposed without knowing it, and what happens when the quiet phase finally ends? The most powerful illusion in currency wars is stability, because when people believe money is stable, they stop questioning the systems controlling it. And that's exactly when long-term shifts accelerate unnoticed. Central banks rarely say they're weakening a currency. Instead, they promise support, liquidity, and confidence, words that sound protective but often signal strategic repositioning. History shows this pattern repeating with uncomfortable precision. After World War II, the US dollar didn't dominate because it was perfect, but because it was trusted more than broken alternatives. Over time, that trust became a weapon, allowing deficits to expand, debt to grow, and policy flexibility to increase without immediate punishment. But here's the twist most people miss. Stability is not the absence of conflict. It's often the phase where rules are quietly rewritten. When interest rates are suppressed for years, savers are punished without headlines. When money supply expands faster than productivity, purchasing power erodes slowly enough to avoid revolt. And when governments coordinate policy, competition shifts from growth to currency positioning. This is why markets can rise while living costs rise faster, why employment numbers look strong while financial stress spreads underneath. Stability becomes a narrative, not a condition, and narratives are powerful because they delay reaction. By the time people feel pressure, policymakers have already moved on to the next phase. This isn't accidental, it's strategic patience. Currency wars reward those who understand timing, not those who wait for confirmation. If stability is being used as a shield, who benefits from believing it, who pays the hidden cost, and how long can confidence survive once reality starts leaking through the story? Every major financial power shift in history started the same way, not with collapse, but with denial. Empires don't fall when people panic. They weaken when people insist everything is normal. Look back at Britain before World War I. The pound was still global, London was still the financial center, and yet, beneath the surface, debt was rising, productivity was slipping, and competitors were quietly positioning themselves. The warning signs weren't dramatics, they were boring, technical, and easy to ignore. That's exactly why they worked. The same pattern appeared before the end of the gold standard in 1971. Markets didn't crash overnight. Instead, pressure built slowly as the US printed more dollars to fund wars and social programs. Confidence didn't disappear suddenly, it thinned. And when trust finally broke, the system didn't ask for permission before resetting. Here's the uncomfortable lesson. Financial dominance doesn't end with a bang. It ends with a transition that only becomes obvious in hindsight. The public always notices last. Elites, institutions, and governments move first, hedging risk, while the story of stability is still being sold. That's why gold accumulations rise quietly, why bilateral trade agreements grow off camera, and why alternative payment systems are built long before they are needed. History doesn't repeat loudly. It whispers until it's too late to ignore. And the most dangerous moment isn't crisis, it's the calm before the rules change. So if every past monetary reset looked manageable right before it wasn't, what phase do you think we're in right now, and who is already preparing while others remain convinced nothing is wrong? Here's the part most people never hear explained clearly. Modern stability is no longer built on growth. It's built on debt maintenance. For decades, the global system worked because expanding economies could absorb borrowing. Today, that equation is breaking. Governments aren't borrowing to invest in the future anymore. They're borrowing to protect the present, to keep markets calm, to prevent unemployment spikes, to stop asset prices from falling. And every time rates rise, that debt becomes heavier, louder, more dangerous. This is why central banks are trapped. Raise rates too much and debt collapses under its own weight. Cut rates too fast and currencies weaken, inflation returns, and confidence erodes. There is no clean exit anymore, only trade-offs. History shows this pattern clearly. Late-stage systems always rely on financial engineering instead of productivity. Numbers look strong, but only because the cost of failure keeps rising. The illusion of control becomes more expensive every year. And here's the uncomfortable truth. When stability itself becomes costly, the system is already fragile. That's why gold reacts before recessions are officially declared. That's why currency volatility increases during good economic data. Markets aren't reacting to today. They're pricing tomorrow's risk. The system hasn't broken yet, but it's straining underweight it was never designed to carry forever. The question isn't whether debt matters, it's how long confidence can ignore it. Because once trust starts asking questions that interest rates can't answer, the reset doesn't begin with panic, it begins with repricing. And when repricing starts, who do you think absorbs the cost first? Institutions with hedges, or everyday people who believed stability was permanent? If money were only numbers, systems wouldn't collapse, but history proves they do. Because beneath every currency, every bond, every market rally, there's one invisible pillar holding it all together: confidence. Not trust in leaders, not belief in policies, confidence that tomorrow will function roughly like today. And that confidence is no longer as solid as it appears. When people stop asking, how much will I earn? And start asking, will this still work? The psychology changes. You can see it in subtle places. Households stretching budgets despite strong employment data, investors hedging during record highs, central banks speaking more carefully than ever. These aren't signs of panic, they're signs of quiet repositioning. History shows that confidence doesn't disappear overnight. It migrates. It moves from paper promises to tangible anchors, from growth stories to protection strategies, from optimism to optionality. That's why gold, energy assets, and alternative stores of value rise during periods that look stable on the surface. People aren't betting on collapse. They're buying insurance. And insurance demand rises when uncertainty becomes structural, not temporary. Here's where it gets uncomfortable. Governments can print money, cut rates, or issue statements, but none of those manufacture confidence. Confidence forms when outcomes match expectations. Right now, expectations are drifting while narratives stay fixed. That gap is dangerous. When confidence shifts quietly, markets don't crash. They reprice, asset by asset, currency by currency, sector by sector. By the time headlines catch up, positioning has already changed. That's why the biggest financial moves often look boring at first. No drama, no sirens, just gradual adjustments that later feel obvious in hindsight. The real question isn't whether confidence is falling, it's where it's going next. And if capital is already preparing for a different future than the one being publicly promised, are most people positioned for where the system is headed, or where it used to be? One of the most misunderstood moments in economic history is not collapse, but pretended stability. This is the phase where systems still function, markets still open, and officials still speak calmly. Yet the effort required to keep everything normal quietly increases. Interest rates are adjusted more frequently. Language becomes more careful. Forecasts gain more footnotes than confidence. Stability, at this stage, is no longer organic. It's managed. And managed stability is expensive. It demands constant intervention, constant reassurance, and constant credibility. History shows this phase clearly. In the late 1960s, governments insisted inflation was temporary. In the early 2000s, leverage was contained. Before 2008, risk was well distributed. Each time, the system didn't break immediately. It performed stability until reality outpaced the script. That's where we are again. Today, growth exists, but it's uneven. Employment numbers look strong, but purchasing power feels weaker. Markets hit highs, while households feel stretched. That contradiction isn't an accident, it's a signal. When data and lived experience diverge, people trust experience. And once enough, people quietly adjust their behavior, saving more, spending less, hedging risk. Momentum shifts without a headline. Here's the uncomfortable truth. Authorities don't lose control when markets fall. They lose control when their words stop changing behavior, when rate cuts no longer excite, when stimulus no longer reassures, when warnings no longer scare. At that point, stability becomes a performance for credibility, not a reflection of reality. And performances can continue until they can't. The danger isn't panic, it's delayed recognition. By the time instability is visible, positioning has already changed. The question isn't whether today's calm is real or fake. It's how long performance can substitute for confidence. And when stability requires more effort each month just to look the same, who notices first? Those watching the headlines or those quietly moving their money. Economic systems don't collapse when numbers break. They weaken when trust relocates. This is the phase almost no one talks about in real time because it doesn't announce itself with crashes or chaos. It happens silently through choices, where people store value, what they believe will still work tomorrow, which promises feel durable and which feel fragile. Historically, this shift is subtle but decisive. In the 1970s, trust moved away from paper promises toward hard assets. In the 1990s, it moved toward growth and globalization. After 2008, it moved toward central bank protection. Each era had a center of gravity, might become something people believed would hold. Today, that gravity is drifting again, not disappearing, drifting. You can see it in how investors hedge more aggressively, even during good times, in how countries talk about diversification instead of dominance, in how individuals care less about returns and more about resilience. That's not fear. It's adaptation. And adaptation always precedes transformation. The most important detail here is that trust doesn't vanish. It migrates. It moves away from centralized assurances toward optionality, flexibility, assets, and systems that don't require perfect conditions to function. This is why volatility doesn't scare markets the way it used to. Unpredictability does. When the rules feel unstable, people seek structures that survive rule changes. Here's the pattern history repeats. First, trust stretches, then it fragments, then it consolidates somewhere new. We're in the stretching phase. Official systems still work, but they feel thinner. Promises still hold, but with more conditions. And once trust stretches far enough, it doesn't snap back. It snaps forward. The unsettling part is timing. This shift doesn't wait for recessions or crises. It happens during calm, during optimism, during moments when nothing seems wrong. That's why most people only recognize it after the fact. The real question now isn't what will fail. It's where trust is quietly being rebuilt while attention remains elsewhere. And if trust is already moving beneath the surface, what happens when the rest of the world finally notices? Every major financial shift begins the same way. The future slowly stops behaving like the past, but people keep using old maps to navigate it. Models still rely on historical averages. Forecasts still assume mean reversion. Policymakers still reference cycles that no longer fully apply. And for a while this works, until it doesn't. History is useful, but only when the structure underneath remains familiar. Right now that structure is changing. Demographics are different. Debt levels are higher. Global coordination is weaker. Technology moves faster than regulation. This means the future isn't just a repeat with new characters. It's a new script. And when that happens, the biggest risk isn't volatility, it's false confidence. In previous eras, recoveries followed downturns because the underlying system was still trusted. Today, even recoveries feel fragile. They depend on policy alignment, political stability, and global cooperation, three things that no longer move in sync. That doesn't mean collapse is imminent. It means predictability is fading, and predictability is the true foundation of financial confidence. When people can't forecast outcomes, they shorten timelines. They become tactical instead of strategic. They prioritize liquidity over yield. This subtle change reshapes markets long before any headline does. You can already see it in how quickly narratives shift, how sensitive markets are to language, and how fast sentiment reverses. The system hasn't failed. It's adapting under pressure. But adaptation always creates winners and losers. Those who adjust early gain optionality. Those who wait for confirmation usually get clarity, but too late. The uncomfortable truth is this. The next phase of the global economy won't feel dramatic at first. It will feel confusing. Signals will conflict. Experts will disagree. And that confusion will push people to either freeze or reposition. History shows that periods like this don't reward certainty. They reward awareness. The question now isn't whether the future will be better or worse than the past. It's whether you're still preparing for a world that no longer exists, or learning to read the signals of the one that's already forming. The final warning sign before any major economic shift is not collapse, not panic, and not headlines. It's behavior. This is the moment when people stop waiting for clarity and start acting on instinct. They don't announce it. They don't debate it loudly. They simply adjust. Spending habits tighten. Risk tolerance shrinks. Long-term commitments feel heavier, and conversations quietly shift from growth to protection. History marks this moment clearly, but only in hindsight. Before the Great Inflation, households began hoarding real goods. Before the dot-com crash, insiders reduced exposure while optimism stayed high. Before 2008, lending standards tightened quietly before freezing altogether. These changes didn't cause the crises. They signaled that confidence had already moved on. We're approaching that behavioral threshold again, not because people are scared, but because they're tired of uncertainty. When uncertainty lasts too long, people stop trying to predict outcomes and start minimizing regret. That's when velocity slows, not dramatically, gradually. And gradual slowdowns are the hardest to detect because nothing breaks all at once. Yet this is the phase that reshapes economies most deeply. Businesses delay expansion. Consumers delay upgrades. Investors demand higher conviction. All of this reduces momentum without triggering alarms. It feels like calm, but it's actually caution. The danger isn't that people are wrong. It's that once behavior changes, reversing it requires far more than reassurance. Confidence doesn't return with words. It returns with time and proof. And proof takes longer when trust has been stretched. The quiet irony is this. By the time behavior visibly shifts, the outcome is already underway. Markets reflect it later. Data confirms it later. Headlines explain it later. Behavior always moves first. So the real question is not whether the economy will change. It already is. The question is whether you'll recognize the moment behavior quietly crossed the line, or only understand it once the story is already written. The most important phase of any financial transition is not the crisis itself. It's the quiet decisions made before the world agrees something has changed. By the time outcomes feel obvious, positioning is already locked in. History is brutally consistent on this point. Those who waited for confirmation got explanations. Those who moved during uncertainty got advantage. Right now, we are standing in that narrow window where outcomes are still flexible, narratives are still forming, and choices still matter more than predictions. This isn't a moment for panic, and it's not a moment for blind optimism either. It's a moment for awareness. Awareness that the rules are evolving, that trust is relocating, that stability is being managed rather than assumed, and that the future will reward adaptability more than conviction. The global system isn't ending, it's rebalancing. But rebalancing always creates pressure points. Some assets gain relevance, some lose privilege. Some narratives fade, while new ones quietly take their place. The danger is not being wrong, it's being late. Because lateness in finance doesn't come with alarms. It comes with opportunity costs, missed hedges, missed positioning, missed time. The people who navigate transitions best are not those who predict exact outcomes, but those who recognize direction early and remain flexible. They don't chase certainty. They build resilience. And resilience is the true currency of uncertain eras. As this chapter unfolds, the most powerful question you can ask isn't, what will happen? It's, what am I assuming will always work? Because history shows that every major reset begins when assumptions quietly expire. If you want to understand how power shifts when control weakens, and why institutions often lose grip before anyone admits it, watch our next deep dive on our central banks losing control, today's reality, history's warnings, and what comes next. This is FINSFAR, and the real story is always happening before the headlines catch up.